so we'll end this episode as we always do. Maybe we've only done 2 episodes, but technically this is as we always do. We end with some notable misses by Benchmark. Because again, nobody's perfect. They may have done eBay, they may have done Uber, they may have done Riot Games, but man, they certainly passed on some big, near Uber, near eBay level investments. And so, I can speculate on why they passed on some of these. Some reasons I don't know. Some I can gather information from what people have said. But regardless, we'll go into 3 major misses by Benchmark that I'm sure they don't like to think about too much. And so number 1, Google. Man, that already hurts. Google. So Bill Gurley describes some reason why they passed. He says along the lines of it was 1999 and search engines were still in this ultra competitive environment, with many questions regarding whether their business models actually made sense. I mean, Google was, I'm pretty sure, the 18th search engine that was created at the time. And so like many search engine companies were starting and many more were failing, consistently. And so it was beginning to look kind of murky. And there were still several questions regarding whether anybody could make a sustainable business out of search, and if anyone could compete with Yahoo, who is now well and above everyone else. The next point he makes was that Sergey Brin and Larry Page, the 2 co-founders of Google, were 2 Stanford PhD students, but were adamant about being CEO despite never running a company before. Which, today isn't looked at as such a big deal, but in 1999, this was extremely novel and gave many investors pause, obviously, including Benchmark. VC firms back then liked to back operators with operating experience. And so backing just 2 PhD students who, I don't know if I've ever even really worked at a company, that's kind of tough, despite obviously how genius they were. And even if you could get past these 2 concerns that we just listed, the price was still remarkably high. Despite these 2 concerns, these 2 anomalies in most venture investments, the price was very high. And Gurley also mentions how, not only the price was high, but the founders, Sergey Brin and Larry Page, were so confident in their product and their abilities to make it successful that it actually started to give the opposite impression to the Benchmark team that maybe these guys were overselling themselves and actually might not be as exceptional as they seemed. So kind of backfired in the eyes of the Benchmark partners. So as a result, Benchmark pursued Google because, everyone was. You can't completely sit out, but kind of did it with like a 1 foot in the door, 1 foot out the door mentality. Whereas on the flip side, Sequoia and Kleiner were pushing hard to get a deal done. They worked very fast. I think it was all settled in a week and a half total from when Google started to raise to when they closed the deal with Kleiner and Sequoia. So Benchmark was never going to be able to invest if they didn't pursue it with that kind of rigor. And so while all of those 3 points were completely refuted just, 5 years later, I believe, when Google went public and continued to accelerate exponentially, they were somewhat reasonable points at the time. I will say, though, if Benchmark looked into the product as intentionally as Sequoia and Kleiner did, they would have seen just how much better a product it was than any other search engine available at the time, and that their technology was far superior than any of the leading search engines. So it seems like Benchmark focused a little too much on the surface layer of Google, the general market, the founders being not really the traditional archetype, the price being high, all certainly concerns, but they didn't really look under the hood, really at the product, which showed a lot of promise, according to Sequoia and Kleiner. And so it's ironic because Gurley is like famous for championing this, what could go right mindset. And Benchmark is famous of championing it. I think it comes from the original partners, Andy Ratcliffe and Bob Cagle of them. And just this phrase, what could go right, being so important in venture. But I suppose they didn't really follow that here with this Google investment. So always engage the founders to learn more about the product and really try to dive into the nuts and bolts, because you could uncover something you didn't see on the surface level, but looks fantastic, when you look under the hood. So number one, starting out on a rough foot with Google. Number two, not getting much better, because number two is Airbnb. And so this one is tough because it's similar to why Sequoia passed on Salesforce, like we talked about last week. It relates to price. Benchmark passed on Airbnb because they have a rule regarding how much ownership they take in a company. Benchmark is adamant that they get around 20% when they invest in a company, because they only do Series A investments for the most part. Sometimes they stretch and do a B or a C, but for the most part, they only do Series A investments. So because of that, they're not doing future growth rounds. They're not doing a lot of follow-on investing. So they need to get a large ownership position at that Series A level to sustain the future large growth rounds that will eventually dilute their ownership. If they get 20% of a company at the A and it goes through a B round, a C round, D, E, G round, they're going to go down to 11 or so percent like we saw with Uber. They can't keep going like Sequoia can and keep a 26% ownership. So price is really important to them, more important than a lot of other VC firms. So Greylock, a firm that does early stage, mid stage, late stage investing, they do life cycle investing, didn't have much of a concern with price. So they led the Series A, putting in $7.2 million for about an 11 or 12% stake in the company, which is far from the 20% target that Benchmark has. Side note, we'll talk about Greylock sometime in the next few weeks or few months. Incredible VC firm. Anyway, so I understand the idea of passing, when it's so far from your target. 11 or 12% is a lot different than 20%. But even if they got diluted to like 2.5% by the time Airbnb went public, which they likely wouldn't, they'd probably hover around 5% or so. At 2.5%, they would still return over $1 billion. So, I'm assuming they didn't see a potential $100 billion Airbnb IPO in the future, like we saw, or 80 some billion, whatever it IPO'd at. Because if they saw that, then they'd say, okay, this is possible. But that's a one in a decade type of company. So I understand how they didn't really see that coming, because if they did, I'm sure they would have invested, because like we talked about earlier, Benchmark targets companies like all VC firms that can return the fund, which for Benchmark is typically around 500 million. So that would have worked. But if it's instead of $100 billion and it's only a $10 billion IPO, well, now you only returned about 100 million. So you can see why they passed. Tough, but sometimes that's just how the market plays out. And, much like we just talked about with Google, if you want to invest in ultra competitive companies like Airbnb was, you can't hesitate. You have to be prepared for when that company raises that you already know everything about their business and market on the outside, so that once they show you the financials, you already have a number in your mind of what you want to invest based on the revenue projections or the market projections. And any hesitation gives your competitors a huge head start, which I'm sure is what happened to Greylock. I'm sure Greylock didn't hesitate what the Airbnb founders said. I'm sure Greylock said yes to, and Benchmark gave a little bit of an before saying anything, which was already too late. So Google, I'm laughing because I just read the third company. Google, Airbnb, and number 3, Facebook. I mean, what a tough list. I mean, again, the best VC firms see basically every company, so they're going to have crazy misses like this. I'm sure I could have found just as big ones for Sequoia, but Sequoia is a little more secretive. So is Benchmark, but Bill Gurley talks a lot. So I found the third one, which is Facebook. And I know I talked about Facebook last week in Sequoia's essay, but I think there's something kind of interesting about why Benchmark passed that's different from why Sequoia passed. And this is something we haven't talked about yet, but it's important, just kind of venture capital 101 stuff. And so Facebook was raising around 2004. And right before that, a year or even less than a year before that, Benchmark had invested in Friendster, another big social media company, basically Facebook's number one competitor. And so they were conflicted out. So for those who don't know, it's common in venture capital to invest in a company within an industry and have to stick with that investment, stick with that one company. So if you invest in eBay, you can't invest in Amazon. If you invest in Postmates, you can't invest in DoorDash. And so if you invest in Friendster, you can't invest in Facebook. The reason isn't only because you picked your team and should be supporting your team, but because Benchmark takes board seats on every investment. And so they can't learn private board level information about Friendster and Facebook. I mean, neither company would allow that. They're direct competitors. And so it would be impossible for Benchmark to keep all that information private. And so the lesson here is that when you're investing in a company, it not only has to be one where you're willing to back it for 10 years, but it also means you have to be willing to not invest in other companies like it for 10 years. And so this trade-off doesn't get discussed much in venture capital, but I'm sure it's one that happens quite frequently. So when you're considering an investment, you don't just have to be like, oh, this is a company I could see being, a winner. I'm willing to sit with it for 10 years. You also have to ask yourself, am I willing to not be able to sit with any companies I might meet in a year or two from now that are direct competitors that might seem better? And you have to think at the time you're investing, this is the best company in this industry now and in the next few years. Makes this job a lot harder because sometimes you'll get a Friendster instead of a Facebook, and you will lose billions of dollars based on that decision. One small caveat: if you're like a small scale angel investor that just does, a few $100,000 or so, I'm sure this is less strict because you aren't taking a board seat, and you're probably not even given much information at all, if any, from the company, because how many small scale angel investors does Facebook have? Probably so many. They're not going to communicate with you as often as they would with a board member. They're way too busy dealing with other things. So, yep, final lesson, just be careful of those conflicts. Be really confident in your investments.